Hi everyone, welcome back to Risk Biscuits. Thanks for tuning in. I'm Michael, your host. Nice to see you again. As always, please support the show, like and subscribe, follow, all that good stuff is much appreciated. Today I've got a very special guest. I'm quite excited about this one. Marcos Bueno. G'day, mate. How are you?
Michael, how are you?
Good, thank you. Thanks for coming on the
Good, good.
show.
I think it's
Some,
exciting. I mean, you're doing something new and brave, so I'm only happy to be a participant and see if we
thank,
can take it forward.
yeah, thank you. Thanks so much. Many of you might know Marcos by his pseudonym on Twitter, Mark Gutman. So we'll have a little bit of a story about that in the not too distant future. But before we get into the show, I just want to put something up on the screen just to sort of cover off on some bases. Look, just a little bit of a disclaimer here. Obviously, this conversation is really for entertainment purposes only. It's not intended to be financial advice. Marcos and I are just having a general conversation. If you're looking for financial advice, please go somewhere else to seek it. If you're listening to two gentlemen just have a quick discussion about markets and what's going on in the world, then yeah, you're probably in the right place. So tune in. All right. So maybe a little bit of a background about yourself. Maybe I'll share what I know about you, and as you can correct me if I'm wrong.
That sounds good.
Um, yeah, but you obviously come from institutional background. You're presently the founder and CIO at Asent Systematic Advisors, which we'll get into sort of what the firm does shortly. But you've worked at a number of firms, Goldman Sachs, JP Morgan, UBS, and Graham Capital. Is that sort of a
Yeah, that's right.
very, yeah, very, very quick, rapid summary of who you are? Um, but maybe, yeah, you could just sort of share a little bit uh, about yourself and sort of really where it all started, like why trading? Why did you become interested in trading? And we can kind of take it from there.
Yeah. So, a lot of people in this industry are very passionate about trading from early age, and they're really passionate about markets and stuff. And that was not me. So it's actually, if you had asked me when I was 15, what would you be doing at your mid 40s? It's like, would never imagine this. But I'm quite happy about it, actually. So I grew up in Spain. Probably people can get it from my accent.
Yeah.
Um, I was kind of a nerdy kid, but an adventurous nerdy kid. I really love reading and math and science and things like that, but I always grew up around bicycles, motorcycles, being in the countryside and doing quote unquote irresponsible things as a teenager with the motorbikes and things I shouldn't like. We're looking back, it's like I was nuts. But at
Yep.
the same time, I really like my schoolwork. Um, um, so following on that, I got into one of the greatest schools in Spain at the time, doing engineering. I saw myself as an engineer. Um, to be fair, I didn't really know what to do, but sort of like industrial engineers seem general enough to not close any doors. And I did actually pretty well in that. And then when I was around 20, I left Spain because it sort of like felt a bit small for me. I wanted to do big things. I didn't really know what it was going to be, but um, I was sort of like I had aspirations, and I felt it was a bit limited. So I actually, without um, speaking any French, I moved to France. I
Wow.
was
Okay.
actually, yeah, I was admitted at sort of like one of the elite schools in France, École Polytechnique. I ran through the exam. I sort of like bumbled my way through in my broken French and half English, half like beginner French that I had started like 6 months before. And I just got parachuted in France there. And that was sort of like the beginning of my international life. Never been back to Spain again. I mean, other than visiting. So that was like, yeah, more than like 25, 26 years ago. Um, so I did engineering. I heard about when I was there in France some of these my classmates were going to London to become traders. And back in the day, say, oh, you go to London to be a trader, you can make $1 million. And I said, that's not possible. It's just like, those are urban legends. It's just not possible. Nobody's going to pay $1 million for anybody. Uh, um, so that was my first exposure to trading. I actually didn't do that because I didn't believe it was true.
Okay.
Um, and I actually didn't even know what it was. So I started doing management consulting. Um, Sounded sexier at the time. So like the class people would go and do that and work for McKinsey and all those things were the sexy things. And I started doing that. And I also, for some reason, I also wanted to do an MBA in America. So basically, 1 year into the job, I started applying to schools, and I was admitted to Wharton. Um, so I was happy about that. I went there,
Yeah.
had a fantastic time. And when I was at Wharton, I discovered finance. And then uh, everybody at the time was talking about M&A and doing deals and private equity and stuff. I was like, oh, that sounds interesting. And there also this other thing called sales and trading. Um, and I was saying, what is sales and trading? I don't want to do sales and trading. That sounds so interesting.
Yeah.
So I interviewed with some banks, and I was lucky to had an offer from Goldman to do M&A. And because of us engineering, and so I did oil and gas, so like resonated with me. And then that was I was hired to work out of London. So I joined Goldman for a 7 week interview, 7 week internship between the 2 years, so 70 days. And out of those 70 days, I worked 68, and I
Okay.
had a couple of all-nighters in there. I mean, it's interesting, but the most interesting thing that happened is that I reconnected with some people I knew that were working in the building across the road, also from Goldman, in the trading floor. And I discovered the trading floor for the first time in my life, the sales and trading side. And I said, wow, this is kind of looks amazing.
Hmm.
Everything that I had just said no to before because it didn't sound sexy or interesting. Actually, when I opened my mind to it and I say it was quite interesting. So talking to the people there and say, these people here, they do a job that is more fun than what I'm doing because it's more intellectual. Uh, they work less, like they get to go home like at 6 p.m. instead of like 2 a.m. They don't work
Yeah.
on weekends and they make double the money. So it kind of sounds better to me than what I'm doing now.
Sounds better to me too.
Yeah. So so actually when I was meant to go back to business school, I landed a second internship at Goldman on the sales and trading desk, and I stayed for another 4 weeks, and I had a blast. And they didn't want me to go back to school. They wanted to hire me immediately, and it's maybe I should have, to be honest. But I said no, I want to get my degree, and so I went back. And then after that, I joined Goldman, and I was doing a lot of exotic derivatives and structured products and things like that. That was a lot of fun. Um, and then when I was there, I was like, that my clients are having more fun than me, basically the
Okay.
buy side people.
Yeah.
So I say, okay, um, that sounds interesting too. And after a couple of years of doing that, basically through the Wharton network, I got a job at the UBS prop desk doing stocks and commodities from a value perspective. I um, So like the classic way of investing, you do a look at the fundamentals, uh, meet with management. I travel all over the world, going to mines and oil fields and meeting management teams. And I was there with like barely 30 and meeting with grizzled CEOs. And it's like, because I had UBS money, they would listen to me. But um, I said, this is kind of cool. I didn't realize the importance of the UBS money at the time. I thought it was me
Yeah.
that liked meeting. In retrospect, what they liked meeting was the UBS kind of balance sheet. So they
Yeah.
will they will they will answer all my questions with a smile. So that's fun. Um, anyway, so that was interesting. It went well. Then UBS started to go not so well when we were going into the financial crisis. Uh, UBS started to lose a lot of money. It was not a place to be back in the day. And that combined with something that I kind of learned with the market is like I did really, really well. And I thought it was me. But I also realized like, a little bit later that I did really well because I was long in a bull market, right? And I bought into all the narratives and stuff. And I was like, I really didn't know what I was doing that much. Uh, but a couple of years in, I sort of realized that what really mattered was not so much what I was doing, but or what the stocks I was picking, but really whether we were in a bull market or a bear market, right? Um, because if it's a bull market, that's the number one question you need to answer, right? What kind of market are we in? Are we bull market, bear market? And if we bull, then go long. And if you're not in a bull market, you're bear market, you go short. And and that's going to determine most of your results. I mean, if you're not aware of that, and then you start trying to do like quote unquote the right thing, uh, if you're long in a bear market, you're not going to make money,
Hmm.
no matter how good your stock picking is. I mean, you can, and it's not impossible. You can, but basically your odds are really bad, and
Yeah.
you're really swimming, um, like trying to sail against the wind. So you're giving yourself a very hard time. So and that also related more to the sort of like the macro perspective, the bigger picture, and that resonated with me more than the stock picking. I mean, I love going all around the world. Um, Went to Australia, went to China, South America, Canada, all around the US and Europe and stuff. Um, and that also gave me a bit of a global perspective. And so global macro was like, instead of just being very narrow focus, it was like more broad, more broad, more. I find it really interesting to learn about different countries and like macro. So given that UBS was not doing so well, I started looking at something else, and JP Morgan hired me um, to go to the commodity prop desk. And it was called the commodity prop, but in fact, it was a macro desk. They were doing a
Okay.
lot of currencies, obviously a lot of commodities, but they were doing a lot of equity futures and things like that. But they weren't doing an equity cash. And I had this commodity understanding and equity cash. They didn't have anybody that was doing equities, so I brought in to sort of like um, be the equity guy. Um, and that was the best place I've ever worked at in terms of the the capital that we had, the flexibility that we had, the culture that we had. It was like really, really um, a nice place to work.
Okay.
We had a lot of money to deploy, and I learned a lot about risk management there actually, because when you are a value guy, when you're a fundamental guy, the the main premise of the work is that the market is wrong and you are right. That's the
Yep.
mentality of a fundamental value driven guy like I was. When you go to a macro desk or a bigger picture desk, um, it's interesting because you know that you don't know. And then your assumption is that the market is right, and then you are wrong. You may
Hmm.
have views, you may have stuff, but the risk management aspect is like, okay, the market is not confirming what I think. I must be wrong.
Yep.
As opposed to the value guy where it's like, oh, this thing is going down. I'm going to buy it. It's going down. These people are stupid. I'm not.
Yep.
So actually, that was a big, big learning for me in terms of the philosophy of risk management, how to respect the market, how to go with the market. And then if it's a bull market, you go long, you never go against it. If it's a bear market, you go short. So it's like a really interesting, um, uh,
Quite a different mindset too, like very hard to
com-
switch from one to the other.
completely different mindset.
Mm.
And I typically, I mean, in retrospect, the reason why value investing is so hard is because it's not only hard to figure out the fundamentals and valuation, is because the premise is that when something is going against you, you're going to be buying more of it. Um, and when something is going your way, you're going to end up selling it because at some point, at some sort of like target price when it's not value anymore. So basically, you're capping your upside and you're letting your downside uncapped.
Hmm.
And that's not a good recipe for making money.
Yep.
So on top of the difficulty of the value investing itself, is that you're making it very hard on yourself um, in terms of the limited upside, unlimited downside. Whereas the macro perspective is like you're aware that you know a lot less. You don't believe in your views as much. So that means that when a trade goes against you, you're going to cut it quickly. But you also understand that when it goes your way, you don't really have a target price. You will go with it as long as it's working, typically. So there's a bit of a trend following mentality. We'll get into that. But basically, structurally, it's a much better setup to make money because when you lose money, you don't really lose a lot. But when you make money, you could make a lot. It's the
Yeah.
opposite of the value approach. So so that is a much more rewarding experience in the market. I really enjoy the fact that I was looking at all sorts of different things, not getting too much into the weeds. Realized that I enjoyed that much more, and that was great. And that was great. Then Volcker rule came, and they got rid of all of us. Volcker rule was the new law that said that banks could not have prop trading,
Yeah.
and that was me and all my the people I was working with. Everybody was just like, "Sorry, guys." So yeah, that was like shit.
What now?
Surely, yeah. Well, now, yeah. Um, I remember I was in the States when that happened, and I went to the beach like 5 in the morning or something because obviously the guys were in London. I was in the States. We had the meeting with HR like at 5 a.m. So like, guys, we had news. Yeah, so that was not a fun thing. Anyway, fast forward a few months, and there is this hedge fund, American hedge fund that was setting up in London, and they reach out to me and say we're doing this, blah 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 blah. And I went, good, good. So I was the third hire in the London office. I was started to run a macro commodity book, basically putting together all my commodity experience, equity experience, but also macro to, and that started fairly small. We started being three, then we ended up going to 25 people. I think we had 4.5 billion AUM in London. I was running one of those 4.5, so it was great. And that was a platform sort of like Millennium, where it's a multi-manager platform, and we had PMs, and each PM will run a portfolio. So I was sort of like a partner PM, and that was a great business model for the PMs, uh, for the investors, and also for the owner of the business, in particular, the owner of the business.
Mhm.
So I saw that, and that already had been like 10 years of trading for me. Um, and I was kind of ready for a new life. And I was in London. My wife was also ready for a new life. We had three children, and I saw the opportunity to create a multi-manager firm like Graham, like Millennium, uh, like all those guys. So like narrow focus on commodities. And the reason
Okay.
is that commodity PMs tend to be very specialized. They tend to be markets with not a huge capacity on an individual basis. Like you can only trade so much nat gas. You can also only trade so much coffee or copper, or oil is bigger, but still has limits, right? Or like oil products. So that's a limited capacity. You put them together, you have a more institutional setup that can it's accessible for institutional investors. And also, from an investor perspective, the LPs, the institutions, don't really, the commodities is kind of a complicated stuff. They don't really have a lot of expertise in house, tends to be small allocation of their portfolios. Um, they want to have a diversified exposure to commodities because you don't want to, if you, let's say you have 100 million to invest in a fund, you don't want to have 10 funds. So what are you going to do? So I said, okay, this is a solution to that problem. In addition, we have commodities are very unrelated to each other many times, so it's uncorrelated, and you can have cross-pollination and alpha sitting, for example, not only the crude guy trading by himself, but next to the guy that is doing oil companies, and they can exchange information and cross-pollinate. That's
Gotcha.
because
Yep.
those markets are very siloed. So you put them together, actually they do better. And then the products guy next to the crude guy, next to the refinery guy, and having this like pot shop of commodity people. And that was an amazing project. Fast forward 3 years, I had an amazing team, and I had $200 million from a seeder to launch it. And that promise never really became a reality.
Okay.
So that was a big setback. That was a big setback. Um,
Why it just didn't work or
I don't really have a good answer of why they didn't follow through. The official number story was that they had been doing badly internally and they couldn't get final approval to deploy to new ventures.
Okay.
And then the guy that we were talking to left, and basically the whole thing sort of like evaporated.
Okay. Yeah.
Uh, so that cost me a lot of money in terms of opportunity cost and actual money and time. It was an
Yeah.
amazing experience in terms of setting up a big hedge fund, institutional quality, and getting all the systems and getting. I had like 9 people working. That was. I mean, I'm happy that I did it. It wasn't
Mm.
easy, and it was a bad outcome in the end. But I learned a lot and sort of like grew up a lot as well.
Yeah.
So
Yeah.
so that was good. But also the reality is that after that happened, I was completely burned out with the industry, and I just didn't want to
Yeah.
talk to
Okay.
anybody.
Yep.
Say, you know what, I'm tired of this. We had hundreds of meetings with investors and stuff, and we were almost there, but not there. So that was really frustrating.
Yep.
So what I did is, that, you know what, I went back to my roots, and I said, I just want to take care of my kids and be with them and have them grow up. And I still had capital left, so I started trading my own capital.
Okay.
And what, and so I became a completely independent. I didn't want to have employees or clients or just me doing what I thought it was right in the market. And one of the things that I thought is an idea I had had years before at Graham, because Graham is I think they have 17 billion now or 18. They have a big macro discretionary business where I was, but they also had a big quant business, mostly trend following in futures. So
Hmm.
when I was there, I thought this is a great. I basically discovered the quant trading and in particular, so like the nitty gritty detail of trend following. And I thought this is a great application for equities in particular, so like single stocks,
Hmm.
um, because the trends for two reasons, the trends in stocks can be gigantic. Like a stock can go. You look at something like Nvidia, SMCI, it can go from 10 to 100, it can go to 1,000. You never get that in futures in the FX markets or in commodity markets, or even in the indices. They're much smaller moves. Um, so that's one thing. The trends are super powerful. There's a massive asymmetry in terms of the risk you're taking on the long side, how much you can make versus how much you could lose. I mean, even if you had no stops, you can only lose one time what you put in, but you can
Yep.
make multiple times of that. So it's an amazing asymmetry in equities. So that's one reason. And the second reason is that there is literally thousands of different stocks.
Mm.
No matter what environment we are in, no matter what is happening in the world or what are the players that are in the market, we will always have stocks that are doing well.
Yep.
Sometimes a lot of them, sometimes very few of them, but there's always something that is doing great because for whatever reason they're benefiting from the environment or the current environment at the moment. So I put those two and two together and say this is the way to make money in stocks. Basically, is to find the uptrends, get on the trends, be disciplined with the risk management, and profit. Dot profit. Um,
Profit. Yep.
uh, so that's an idea I had when I was at Graham, but I had bigger ideas. So when I was by myself, I went back to that and basically uh, I just did it. And and I started doing it for my own account. It is great, and then it became a business
Okay.
because people were interested in what I was doing. I think resonated with a number of investors that had tried other things before, and many people got that. It's like, you know what, this makes sense. I like it, and that's how Ascent Systematic Advisors was born. So basically, after 2 or 3 years of being by myself, I was ready to re-engage with the industry again, reconcile with the whole process, and this is what I do now. So basically, we have managed accounts, we help IRAs. I have a vehicle in Luxembourg for non-US investors, and yeah, that's what I do. That's you know, long run about the story of me.
Yeah. Cool. No, that's really interesting. Like, your experience is very broad compared to, many other people. Like you've been down the sort of management consulting, the M&A, the sort of single stock fundamental guy, the prop desk, commodities,
Macro,
macro, yeah, and now
hedge
now
fund
sort of
guy.
finally, yeah, now into trend following. So you've sort of
Yeah,
been a little bit of everywhere, which is interesting.
yeah, I think that gives me kind of a unique perspective. I haven't come
Mm,
across any other profile like mine. So obviously, I'm not a massive specialist on anything, but at the same time, I've been able to sort of like take stock or like have a broad perspective of how markets work, how participants work, and now I like to say that in a long enough timeline, everybody becomes a trend follower. Why? Because it's actually the to me the holy grail of investing.
yeah,
There are two ways for me to invest in it. One is trend following, and the other one is sort of like distressed special sits.
yeah, okay,
Why? Because let's say investing markets are hard. There's a lot of people involved. They all have different expectations, experience, goals. But generally speaking, the market is kind of smart. It's
yep,
hard to find sort of like a mispricing. Um, the typical approach is okay. I'm going to look at the fundamentals. I'm going to analyze those. I'm going to look at valuations in particular stocks, but it can be applied for anything else. Um, and then I'm going to I'm going to do that. I'm going to be smart, and then I'm going to buy the things that are undervalued. That sounds very good in principle. It's very hard to do because other people are doing that, and most likely when you find something that is mispriced, it's mispriced for a reason, and you think it's mispriced because you haven't understood why it's mispriced.
yep,
Uh, and any case, and when you get it right, which you can, then you buy something, it goes up, and then you sell it and you make money when that happens. Now, I sort of like one step beyond, and I say, okay, I don't actually need to do all that work of fundamentals because I can get it wrong. Not only that, I can also get wrong. I can get the fundamentals right. I can get wrong what the market is how the market is going to interpret those fundamentals because they may be driven from other things, right? Uh, like people buy stocks because it makes them feel good to own a stock,
yep,
um, or because they think it's going to go higher, even though they recognize that it's overvalued, but they think other people are going to do it. So like there is all this like herd mentality, and um, so the fundamentals play a role, but not all of it. At
no,
least in any reasonable time frame that people can withstand the market going against them. So basically, my conclusion, I'd like to simplify that and say, okay, if I'm going to buy something, it needs to go up for me to make a profit. So why bother with things that are going down if I'm going to make money when it goes up? So it's much better to find something that is going up, and then because the chances of it's going up for a reason, whatever reason it
mm,
is. It could go up because fundamentals are good, because the operators are good, because there is some change in society that makes it put in a good place, because people are enamored with that stock, or whatever reason. Doesn't
yep,
matter the reason. Chances are that that reason is persistent in some way. So chances are that the trend will continue. Um, so it's much better to just find the stocks that are doing, instead of trying to find a stock that will do well in the future, is try to find the stocks that are doing well today. And
hmm,
chances are that those stocks will continue to do well because they're doing well today for a reason. And is in the same way that it's hard to pick tops, it's hard to pick tops when you don't want to pick tops. So
mm,
basically, if you get on in a stock that is doing well, chances are it will continue to do well tomorrow.
yep,
Basically, you try to find a tailwind and just set yourselves to benefit from that tailwind, as opposed to just try to be too smart and try to find something that will do well tomorrow or like in the future. Just try to find something that is doing well today, and chances are tomorrow will do well. Now, it's
uh,
not
uh,
always the case.
yeah,
Hmm?
but I feel like that's like a key kind of message there. Like a lot of particularly retail investors, you sort of when you and even myself when I first started investing, you're trying to find the hidden company, the undervalued company, the one that no one understands, and putting a lot of time and energy and resources into fighting the market as opposed to just saying the market likes Nvidia for whatever reason. I'm going to buy Nvidia for lack of a better example, just, keep on sort of current examples. Um, and if you are just buying things that are going up, it's, yeah, generally a lot easier.
It is a lot easier. Yeah. I think that what what you described, I think that that's something that I also went through, and I think a lot of people go through, and some of them stay there, some of them do not. But it's kind of like the hero journey, right? We have
Yeah,
this idea that you want to be a hero, right? It's like you're gonna find this hidden gem that nobody knows about, and I'm going to be a hero. Uh, I think that we all want to be a hero. It's nice, but at the same time, it's much better to make money,
yep,
at least when it comes to trading, because actually that's the goal of trading, make money. You want to be a
yep,
hero, just go outside of school and then let stop the car so the kids can cross. That's a more rewarding hero experience than
yep,
trying to be a hero in the market. So basically, when it comes to make money, I think it's easier, it's better to find the easier thing to do um, than the more difficult one. Because a dollar that was easy to make is worth the same as a dollar that was hard to make.
yeah, absolutely. So one
So
of the
much better to
things,
do the easy one.
yeah, absolutely. So one of the things I noticed on your website, you sort of obviously you talk a little bit about what you do and your approach to the market. And there was a sentence on there that kind of struck me, and I'll just read it out. And you've probably kind of mentioned it, but you're sort of talking about your investment process, and you say, my goal is to use fundamental principles of money management to profit from market inefficiencies originating from discretionary managers' cognitive biases, from which I also suffered, and to exploit persistent asymmetric opportunities in stocks. So I think you've sort of touched on it already, but can you expand on that idea for me?
Yes. So um, when I say you see, do the easy thing, it's a bit misleading because trend following is actually really, really hard from a cognitive perspective. Uh, what is much easier to do is the hero journey and trying to be a little bit of a contrarian. That's much easier.
Okay.
Um, it's also because psychologically we feel better, we feel better about ourselves. So we're gonna naturally gravitate towards that. Then the other thing that is very, very hard is that psychologically it's much easier to get into a position and when it's losing money to tell ourselves that we are still right and everybody else is wrong. It's very easy to do that.
Yep.
We feel much better about ourselves than saying, okay, this is wrong. I need to take the hit and get rid of my position and take a loss. Most market participants feel very comfortable with a losing position and very uncomfortable with a winning one. Uh, and that's kind of counterintuitive, but that's the reason why that happens is because as long as you don't haven't taken the loss, it doesn't feel like you have taken a loss, even though
Mhm.
you already have taken the loss. But as long as you don't crystallize it, you still have this optionality of coming back. You can still tell yourself that you're still right, and you don't have to really admit that you did it, that you messed up.
Yep.
Admitting that you messed up is really hard. So it's much more comfortable to ignore it and say, "Is they are wrong, not I'm still right, and I'm gonna show them." I, that's what we want to do. Uh, on the other side, when we have a winning position, we are excited. It's a high. We are scared that we're going to lose the profits because we're scared it's going to go down. That's what scares us. So have a tendency to take profit as soon as we have one because that's a win. Having a win feels good. And once you lock it in, you're not going to lose it. So our tendencies is to sell our winners way too quickly and hold on to our losers. It's very similar to the value investor approach.
Yep.
We're structurally making it hard for ourselves. That's how we are wired. Those are the cognitive biases, among others, that make markets hard. Making money in the markets hard. I think it's relatively easy, quote unquote, easy to understand what the narratives are, to understand where value is, to understand what the things that are overvalued or undervalued. I think that's relatively, it's not that hard.
Hmm.
What is really hard is to go to the next step and then put on a position and manage that position,
Mm.
putting the right size and being basically have the intellectual ability to cut losses quickly when the trade is not going our way, and to hold on for the ride when the trade is going our way. That is the real hard to do. In trend following, in principle, uh, is really easy. It sounds too easy. Actually, too many people say cannot be that. I mean, that sounds too easy. And it's easy to understand. It's extremely hard to put in practice because it goes really against everything that we feel.
Mm.
We feel like holding on to losing positions, and we feel like selling positions when they're winning. It just basically goes against what we feel. Uh, Sometimes I say that every trade in trend following feels bad. Every single one
Okay.
feels bad. When I buy something, I buy something that is optically high. It doesn't feel great. When
Yeah.
I'm selling something in the hole, typically, because the trend has changed, and that feels terrible.
Mm.
Basically, I'm also always selling before below and below the high. I'm either losing money because I got into something and it turned around and basically called the top, and then I'm a week later I'm selling it at a loss. That feels absolutely horrible. Or something is doing great, it's going, and then it turns around and I had given up P&L from the top, and that also feels terrible. So
Mm.
everything feels bad. If left to our own devices, we will never do that.
Yeah.
That's why trend following typically works sort of like from a machine needs to do it. It's hard, it's easy to understand what the machine needs to do. It's very hard to do it ourselves. So we need
Yeah.
to, one of the things that I basically learned is that opinions and views are counterproductive most of the time. I needed to get out of my own way. I understand how the money is made, but I understood as well that it will be better if I don't do that and I let the machine do it. So I
Yeah.
can tell the machine what to do it and not do it. It's similar to sort of like being fit and healthy. Everybody knows how to do it. It's like
Mm.
you eat well, not too much, and you exercise regularly. I
Yeah.
mean, the rules are that with doing that, you're 80% there, right? You take care of your food, you take care of your exercise, and you will be fine.
Yeah.
Everybody gets that. And yet it's really hard.
Yeah. And most of us don't
And
do it.
everybody, most of us don't do it because we are not wired to do that. We are wired
Mm.
to sort of like be lazy, and
Yeah.
basically not cutting losses is being lazy, and not letting trades run is lazy because it's we wired that way. Um,
So,
so yeah,
so the,
this happened. Yeah, so to close it, this happens because I was able to see experience a lot of different things in my
mhm.
career, and that gave me that perspective, seeing very different people operating in different ways. So like I think I was able to distill that in sort of like what the core is of making money in stocks, and I think this is the way.
Okay. So then if we're talking about trend following, then obviously it's a systematic strategy. So is that all like is that in a model in a computer that's making all of your decisions, or are you, I guess, how are you getting to the point where data's being spat out that says buy this or sell this?
So basically, as I grew up as a trader, portfolio manager, I became more and more rules based. At the beginning, it's more about vibes, what I feel, what I think, and then as you mature, the traditional path is that you became a lot more process driven, a lot more checklist driven, a lot more rules based. So what I did basically is okay, this is what I need to see um, before I put on a trade.
Okay.
And these are things that you can code into a computer. That's a relatively easy side of the things. The secret of what I do, sort of like the real IP, is how to do a portfolio of these stocks that are not correlated, or they are uncorrelated to a great extent, and they are uncorrelated forward looking, not just backward looking.
Okay.
Because as opposed to futures, I mean, you do trend following in futures, that's relatively easy in the sense that, okay, you apply the whatever trend following rules you like. Uh, there's kind of different ways of approaching it, but basically they all are in the same ballpark. They're basically the same. Why? Because trend following is very robust. It
Yep.
works. And no matter how you define the trend, it's going to work. Sometimes, in some cases, this method will work better, and some other cases, that other method will work better. But overall, they all work because trend following works. In stocks, in futures, you have, let's say, 25, 30 markets. They're all unrelated to each other. Like you can have Nikkei, you can have NatGas, you can have Eurodollar. They typically are different things. So they
Yep.
tend to be naturally uncorrelated. And when you apply trend following principles to all these markets, all your positions are going to be naturally uncorrelated, which is a good thing.
Mm-hmm.
In stocks, it's slightly different because you don't have 30, you have literally 5,000. So
Mm-hmm.
how do you make a portfolio, let's say 25 stocks out of these 5,000? That's You don't have that problem in futures, because in futures you just take all of them. You
Yep.
cannot do that in stocks. And that's one problem. And the second problem, which is slightly harder, is how do I make sure that when I pick 25 names, they're not out 25 times the same driver?
Yep.
Because stocks are very correlated to one another as opposed to futures. Like you could have, I don't know, let's say oil is doing great. You have all the oil companies trending, right? So you find 25 companies that are trending. They're all oil companies, but in fact, you're not diversified. You have all your risk into one trade, into one
Yeah.
trade.
You're just long oil
Split,
effectively.
yeah. So how do you pick 25 names that are uncorrelated or that are driven by their own idiosyncratic driver as opposed to some sort of macro driver that is affecting all of them?
Yeah. Okay.
I think that's the hardest part. Um, I think I cracked that problem. Actually, don't really tell people how I do it, but
Yeah.
um, because that's kind of like the core of the algo. Um, so um, so I try to find stocks that are trending up. They're all trending up. All my stocks look the same. It's basically bottom left to top right. Um, they more often than not the trend continues. More often than not on earnings days they pop up, which is a good thing. Trend is amazing. It's an amazing thing. Um, and then the key is to find them uncorrelated. That's one. And the second one is portfolio sizing.
Mm.
Uh, how do you how do you size your position? That's something that on Twitter and sort of like in the conversations on a day-to-day basis, nobody really talks about. Everybody talks about the picks. Everybody talks about um, what are you buying? What is the value? What is undiscovered gem? But really, one of the key things for being successful at the market is managing your sizing.
Yep.
Um, and that's also another, like, it's not a secret, but it's something that not a lot of people pay attention to. Sometimes I made the analogy is like when you play golf, it's like a drive for show and put for dough, right?
Mm.
Sizing is putting.
Yeah. Okay.
The stock
And
picking is what everybody wants to see, but really where the money is made is on the green.
yeah. Okay.
Um,
Yeah, that makes sense.
so this is the
And then,
same.
s- and then, so is your position sizing 100% systematic, or do you use some
It's
sort of discretion in that?
everything no, everything is systematic.
Okay.
Uh, Picks, the sizing, the entries, the exits, everything. The only thing that is not system automatic, let's say, is the execution. I do the execution.
Okay.
Um,
Yeah.
because that execution can in futures is not a big issue. In stocks can be a big issue because liquidity is not always there.
Hmm.
That's also something to be careful about. Um, but I traded stocks for many years, so I also bring that experience of being able to trade what is in effect illiquid securities. I mean, when we look at macro, we're trading futures, we're trading treasuries, we're trading effects. Those are like quote unquote infinite liquidity.
Yeah.
No, stocks with infinite liquidity, we basically have 20. Everything else is like illiquid compared to the macro markets.
Yeah.
So the execution needs a little bit of a um, finesse, if you
Yeah.
will. And
Yeah.
that's something that, because I don't trade a lot, I do myself to make sure that we don't get into a big issue.
Okay.
But everything is systematic. And the whole idea is to just get the biases out. It's like you want to be healthy, you hire a personal trainer, and actually the personal trainer does the work for you, and you get fit. Uh, so it's
It's
kind of the
good.
thing. That's good. It's
So
a good PT, right?
yeah, exactly. So then are you like one of the questions I had initially when I was sort of thinking about obviously you've got a model and you're running an algo and that sort of thing was where macro kind of fits in with your model, but really what you're trying to do is strip out as much of those macro effects from the individual names to get down to the core of the idiosyncratic kind of movement that or the trend of the 25 or so stocks. Is that right?
Right, to some extent. My goal is to minimize, to the extent that I can, the correlation between my positions.
Hmm.
It's not so, and that is more linked to idiosyncratic drivers. Uh, but there's macro drivers that affect them, right? So, for example, the portfolio right now has around 20 names, and 3 or 4 of those names are related to artificial intelligence. Those are doing really, really well. Um, but there are many, many names that are on the artificial intelligence wave. Um, my goal is to pick those that are sort of like idiosyncratically better than other ones. They're doing well because they're in AI. So that's sort of like the macro tide. But within those, let's try to pick those that are doing better in terms of
Yeah.
idiosyncratic. And for example, I have a chip maker. I have people that are doing um, what's it called, the data centers. Then there are people that build the things for the data center. So basically, they are all in the same industry, but they're not all chip makers, for example. They're
Yep.
not all software makers. Um, so that's how I think you create something that benefits from a macro trend, but at the same time, so like the drivers are idiosyncratic to those stocks. Obviously, macro impacts because that is the tide that is sort of like lifting that in that sector, right? But within the
Sure.
sector, let's try to pick those that are like better than the other ones,
Yep. Okay.
and that are typically in different areas to the extent possible that are in different areas of this industry. So yeah, they will be correlated because they're in the same sector, but they'll be less correlated than two chip makers to one another, for example.
Sure. Yep. Okay. And then with your trend following, I guess, algorithm or strategy, is it just one is it just one set of rules that you're running, or are you running, like 4 or 5 different sort of similar but slightly different trend following strategies side by side, if that makes sense?
Yeah, that makes sense. And the answer is that I basically, I mean, there are many ways of doing trend following, as I said. One of the things that you can change in a trend following methodology is sort of like what sort of trend duration you're trying to capture.
Yeah.
You can go from intraday to multi-year, right? Um, because of my understanding of the stock market, I basically zeroed in a place that makes sense naturally for the stock market, but also made sense from a return perspective. Is that, for example, in the very, very short-term trends like intraday or even intra-week, there's a lot of players involved. Uh, they churn the book a lot. They tend to be very quick. They tend to have big teams and big brain power. It's sort of like a very competitive area. At the other extreme, the multi-year trends, I don't think anybody's involved in there because that would be more like in effect, those kind of people are venture capital and private equity.
Mhm.
Um, and the risk for somebody like me there is two things. You can, when you're doing multi-year trends, you are by definition accepting the risk of big drawdowns.
Mhm.
So that is a problem for me. And also, you don't really know if you're doing a good job for many, many years. Because let's say you cannot say after a year, you cannot say I did a good job because you need to wait 5 or 6 years. So I don't have that kind of time. And I think that it's not worth it. So I basically zero in one area. So basically, I have one model that is calibrated to sort of like the quarterly cycle, and that is a little bit of a heartbeat of the equity market because there's
Yep.
quarterly return, quarterly earnings, quarterly stuff, and there's like basically in the 90-day cycle, you don't have that much competition as the short-term guys. Your drawdowns are not as big as the long-term guys, and very importantly, you can have feedback in like 5 or 6 quarters, um, whether your method is working or not. So that to
Yep.
me was sort of like the sweet spot. And also from a lifestyle perspective, I don't really have a lot of trades because I'm looking to hold positions for 90 days. I'm not turning the book every week. I am
Yep.
turning the book basically every quarter. So that means the pace is a lot more sedated. I can think about things. I can um, it reduces tremendously the friction because every time you get in and out, it costs money, right? So
Yep.
it's very low cost execution. Uh, it provides a good upside without getting into big drawdowns, and it's a relatively quick feedback cycle. So that
Yep.
is the one that I'm running. So it's basically one that is calibrated to that. I don't have multiples. I think there is something to say about having multiple systems running alongside. I think it's not a bad idea. Operationally complicates things, and because this started for me as an independent trader to manage my own money and try to compound for 25 years in a sustainable way, not only, I mean, timing wise and psychologically and
Yeah.
physically able to do it, I zero in something that is quarterly. So it trades from time to time. A busy day is 2 trades. Many, uh, an average week is 2 trades, maybe
Yeah.
3 trades.
That's
So
good.
so that is sustainable. That is low cost. Um, and actually the returns are been exceptional. So I'm quite happy with it.
Yeah. No, no, that makes perfect sense. And it sounds, to be honest, it sounds like a quite a nice lifestyle as well, as opposed to some very high frequency, very stressful, much shorter time frame type scenario competing against, all the biggest brains on the planet.
Yeah, and that's what I used to do at Graham when I was running the big macro portfolio. I was literally working 24 hours a day,
Mm,
Monday to Friday. I mean, my week will start on Sunday afternoon and finish on Friday evening. And Saturday was a day of quiet, but the rest of the day was like a war zone. And I was in London, I was in Connecticut sometimes. I don't know, but BOJ had a decision. I will be up in the middle of the night. Uh, RMBZ, Bank of
yeah.
Australia, China, India, then it will go over Europe, and then it will go through the US. It was like constant, 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 unsustainably unhealthy lifestyle.
Yeah.
Um,
No, it
that
sounds like it.
you can do for
Yeah.
some time, but only for some time.
Yeah, no, it sounds like you've struck a nice balance, which is good. So, given that we've been talking about your strategy and actually you've given us quite a bit of detail and gone into quite a bit of depth, which has been really good. Um, maybe just have a bit of a chat about like a bit more of a relaxed chat about some war stories. So it can be within the current business or in your former trading or whatever it might be, but potentially like your best trade ever and your worst trade ever, and probably more importantly, what you learned from them.
Should have answers to those questions, but I don't really. I think full of shame, I will say that my worst trade ever was being short Tesla.
Okay.
It's not original. Um, it
I've
made a
been
lot of
short
sense to
test.
me at the
I've
time.
been short. I've been short Tesla too myself, and it didn't work out for me either. So
Um, yeah. So the worst thing about it is that um, I knew it was wrong.
Okay.
I mean, I didn't know it, but I could feel it.
Yeah.
And and I tried to be a hero. I tried to be smarter, and just doesn't work.
Mm.
It just doesn't work. Um, Now my best trade, surprisingly, was covering my short Tesla.
Yeah. Okay.
I took a big loss, but it actually went up 10x after I bought it back. So never ever had a trade that went so well. It's just not losing that money was the best trade ever. I had
Yeah.
I had good trades, but I don't think any one trade really made my career.
Okay.
Um, so I mean, in for example, in the last 5 years with the algo, I had trades that gone up 300%, 400% in like 6 months, right? Like even just this year, I've been long SMCI. It's been like a rocket ship. But
Yeah.
that doesn't really, it's one more trade. It's part of that. But
Yeah.
uh, but the short Tesla was bad. Covering Tesla was really good. Um, and that really convinced me, talking about lessons learned, is that I was onto something with this trend following thing and stopping about worrying about what the fundamentals are.
Mm.
People will buy Tesla for the longest time, not because owning Tesla made them happy.
Mm.
They made them feel they belong to something
Yep.
bigger than themselves. And we can call them whatever we like, maybe irrational from a fundamentals perspective, but it was rational from their perspective. There was there was demand for Tesla stock because people were happy owning or being shareholders of Tesla.
Yeah.
That's something that a fundamental manager, when I would put on that trade from a fundamental perspective, I missed. And that was basically that trade to me was the thing that got me over the fence as to the trend following and just looking at market
Okay.
technicals and listening to the market. That was the thing that changed my that was like an inflection point in my um basically in my thinking about markets. And I had these ideas before, but those are the things that crystallized and say, yeah, that is the way to do it, not
Yeah. Okay.
the way I've been doing so far. Because it doesn't matter why people, I mean, from a trend following perspective, Tesla is a great example of things that are make no sense to a traditional investor, but the market will steamroll you because the market is just a bunch of people buying the things that they want to buy. And they wanted to buy Tesla for a number of reasons that were not, from their perspective, they really believed in the story. They're believers. Um, they're super optimistic. That what matter. If you're not, and if you're realistic, you're gonna be steamrolled by the believers.
Yep.
Not only that, it's like they really wanted to belong to some sort of like it was a tribe. It's a group. They made them happy. They feel good about themselves owning Tesla stock beyond
Yep.
the money. Obviously, they all want to make money, but one of the main reasons that people were buying that stock is because it made them feel good about themselves.
Mm.
Uh, and that's really what that is not capturing any sort of fundamental analysis. But the trend following approach will see that
Mm.
and get on it
Yep.
and get on it until it changes.
Yeah.
That
Look,
was
and
so that's the defining trait in my career from a personal perspective, I think.
yeah, I mean, it sounds like you said it was your worst trade, but in some ways it was your best trade because it it sort of forced the flip in your mind and got you on the path that you're on now.
Yes, yeah, definitely. Um, I was almost there, and that is uh, Mark Goodman. My Twitter handle existed before that trade,
Okay.
and and I was I was ready to do that flip um, because Mark Goodman was a character I created. It's sort of like a play on my own name. It's a character I created to separate myself from my trading. I think like many people out there, I struggle managing my emotions when I was trading. Uh,
Yep.
for the longest time, as a professional trader, will people ask me, well, how was your day? Or how are you? And basically my answer will be, I'm doing great or I'm doing badly. And it will be like a one-on-one corresponding to my P&L on that day. I'm doing great today. I'm not doing
Yep.
so. Whereas that was not, I mean, my P&L or my results trading are different from me, but it's very, very hard to separate that
Mm.
emotionally. So that's one of the things I struggle the most. So basically, a way for me to separate those two is to have a trading alter ego that was not me. So
Okay.
Mark Goodman was the trade. Mark Goodman was the trader. Marcos Bueno was the parent of my children.
Yeah, that's good. I like that.
Two different things, two different personalities. So Mark Goodman is the perfect trader. I think it's not that Mark Goodman gets everything right, but Mark Goodman always knows what the right thing to do is.
Mm.
Um, Marcos, me, knows but has emotions, so it's difficult. But Mark Goodman does not have emotions. Uh, so that was a me for a way to say, okay, when I go to the office, it's Mark Goodman, and when I go home, it's not. Mark Goodman stays at
Okay.
the office. And it's like when
Yep.
somebody asks me how you're doing, it's like I'm gonna reply in terms of how my day really was, or like my kids are doing well, or my wife's happy, or like we had a good meal, or whatever, something like that, right?
Yep.
Um, and I mean separated from my P&L results. So that was I say that because I was ready to like I was already there, like in this mid zone where I was separating myself from my trading and saying, okay, this is that the Tesla thing and being systematic. It was a completely separation from me and the actual trading.
Mm.
So that for me is sort of like the biggest uh, war story. That I think I'm sure that I have war stories out there,
Yeah.
um, but I don't really have anything outstanding that can make people laugh.
That's fine. I think the point you make though about separating yourself from your trading is a good one. Like it's something that well that I've always struggled with, not just with my trading, but work in general. Like to I don't know whether it's a male thing or I mean I can only look at it from a male perspective, but this, like that often we identify ourselves around how work is going and find it very difficult to sort of separate ourselves as opposed from our careers and that sort of thing. So yeah, it's actually kind of a like a novel way to kind of trick yourself into separating the two.
Yeah. So when I had a trade going badly, so basically Mark Gurman knows what to do with the trade, which is basically get rid of it.
Yeah,
Um, so what would Mark Goodman do?
yeah, yeah. That's good. I like it.
Or yeah,
Okay, so just sort of taking a step back. So let's say someone stumbles across the podcast and they sort of like what you have to say and that sort of thing. What advice would you give someone sort of starting out in trading and like in terms of how they sort of start and how to approach the market and what's the best sort of steps for them to take?
yeah. A lot of people say that you should trade in a way that is compatible with your character. Um, that is true. That's very hard to do because you don't really know what that means. So my advice would really to start small,
Hmm.
really small. Um, that's one thing. There is no one way of making money. There are multiple ways of making money. I think we need to experiment with different ways, but always small. And then sort of like little options here and there, like options not in terms of like market options, but little experiments, not risking
Hmm.
too much and see what resonates with you, what you can actually handle emotionally, what you can handle um, psychologically, what resonates with your skill sets, what is the thing that you are good at.
Yep,
Sorry, I have some technical issues here.
I gotcha. Can you hear me?
Yeah, I can hear you now.
Yeah.
So I was saying to start small, find your sweet spot, take your time. It's, the second thing is to manage your risk properly um, at any size, and that means to me, cut your losers and write your winners. In a short, that is putting you already in the 50-yard line instead of like 0-yard line. Like you can make a lot of mistakes, but if you don't let any trade get too big of a loss, you will be fine. And
Yeah.
also, don't take your profits too quickly.
Be okay losing. Sorry.
Can you hear me again?
Yep.
Yeah, apologies for that. So be okay with a winning trade going back to zero, a small winning trade. Let it grow. Let it grow. Basically, let the flowers grow and cut the weeds.
Yeah.
It's very easy to go the opposite way. So that from the beginning. So be disciplined in that sense. I think that with those two things, I think that you're whoever's starting, you're already in a good spot.
Yeah.
Small and discipline.
Okay, that makes sense. Are there any final thoughts that you wanted to share? Anything that you wanted to sort of talk about that we haven't had a chance to cover?
Um, no, I think that if anybody wants to talk more, I'm always happy to be chatting on DMs, on the phone. Mark Goodman 9. Easy to find me online as well. Just give me a call, send me an email. I'm happy.
Okay, perfect. Look, I'd very much like to thank you for coming on the show. I've really enjoyed the chat. I
Likewise.
Yeah, I hope everyone who's watching has also enjoyed it. Once again, please like and subscribe, follow the show. Your support is appreciated. And yeah, thanks very much. We'll catch you next time. Cheers.